If you've made money from crypto over the last few years and you have not reported everything to HMRC, you might think you've gotten away with it. But here's the problem. HMRC has just revealed that more than 500 crypto investors voluntarily came forward over the last 2 tax years, paying back over £8 million in unpaid tax. Think about that for a moment. Hundreds of people didn't suddenly become honest overnight, as you might realize. They realized HMRC was about to find them. And if you're holding Bitcoin, Ethereum, Solana, meme coins, NFTs, or you've traded on Coinbase, Kraken, Binance, or almost any other major exchange, this could affect you sooner than you think. Because this isn't just about another tax crackdown. It's the beginning of a completely new reporting system that makes crypto far less anonymous than many people still believe. Let's break down exactly what's happening and why waiting could become a very expensive mistake. Welcome to Taxplained, explaining taxes so you can minimize your tax burden and maximize your freedom. For years, many crypto investors assumed HMRC couldn't really see what was happening inside their wallets. Sure, they knew exchanges collected information, but unless someone cashed out to a UK bank account, many assumed they were invisible. That assumption is becoming dangerously outdated. Starting on the 1st of January 2026, UK crypto platforms must begin reporting detailed customer information directly to HMRC under something called the Crypto Asset Reporting Framework, or CARF. Now, here's the part most people are missing. Although reporting begins this year, the data collection period has already started. This means exchanges are already gathering the identity information and transaction records they'll eventually report. So if your plan is simply to sort it out later, later may already be too late. HMRC isn't waiting for CARF to begin enforcement either. Last tax year, they sent approximately 65,000 nudge letters to people they believe may have failed to report crypto gains. That's up dramatically from around the 28,000 letters the previous year. And those letters aren't random at all. They're designed to say, we know enough to think something might be off. Would you like to fix it before we investigate it further? It's the tax authority basically giving you one last chance to come forward on your own. Because once an investigation starts, everything changes. This is where the numbers become painful. If you voluntarily disclose unpaid crypto tax before HMRC contacts you, penalties are significantly lower. But if you wait until HMRC sends you a nudge letter, or worse, starts a formal investigation, those penalties can increase by 70% to 100% and potentially even more where offshore arrangements are involved. So the cost is not only paying the tax you owed, it's paying the tax, it's paying the interest, and potentially enormous penalties that could have been avoided altogether. Waiting isn't the option here. Waiting is a financial decision, and for many crypto investors, it could become the most expensive decision they'll ever make. There's another reason why this matters now. The UK has quietly reduced the amount of capital gains you can make tax free. Only a few years ago, the annual capital gains tax allowance was over £12,000. Then it dropped to £6,000. Today, it's just £3,000. That's a massive reduction. It means far more ordinary investors are now caught by capital gains tax rules, even if they don't consider themselves serious traders or serious investors. For the disposals made after 30th of October 2024, gains above that allowance are generally taxed at 18% for basic rate taxpayers and 24% for higher and additional rate taxpayers. So even relatively modest crypto profits can now create a tax liability. Is the good news? If you have made mistakes in previous years, HMRC still offers a way for you to fix them. The voluntary disclosure facility remains available for undeclared crypto gains made before April 2024. This allows investors to come forward themselves rather than waiting to be discovered. And that's exactly what those 502 investors did. Together, they paid just over 8 billion pounds, million pounds in taxes. Yes, paying that tax hurts, but paying it on your own is usually cheaper than paying tax after HMRC has already identified you. Now, before anybody panics, this doesn't automatically mean everyone who owns crypto has done something wrong. Simply buying and holding crypto is not necessarily taxable, but selling or swapping one cryptocurrency for another, or using cryptos to buy goods, or receiving certain staking or mining rewards, that all can create taxable events. And that's where many people accidentally fall into trouble. And that's not because they intended to avoid tax, it's more that they didn't realize those transactions counted as a taxable event. Here's one final point that's important, especially if you're watching this outside the UK. CARF isn't only a British initiative, it's an OECD global reporting standard. Many countries are introducing similar rules or have done so. So if you're an American living overseas, an EU citizen investing internationally, or just an expat using foreign exchanges, do not assume your home country's tax authorities will not eventually receive exactly the same information HMRC is getting. The era of crypto existing outside of the tax system is coming to an end. Governments are increasingly building the infrastructure to exchange this information automatically. So this is not just a story for the UK, it's the direction global crypto taxation is heading towards. So what's the takeaway here? Don't wait for the letter. If you know your crypto taxes aren't exactly right, or if you have forgotten to report gains, or is simply unsure whether you have gotten everything correct, now is the time to review your position, because once HMRC contacts you, many, if not all, of the advantages of voluntary disclosure disappear completely. Fixing a mistake before you're found is almost always cheaper than explaining it after you've been caught. And if you're unsure where you stand, speaking with a crypto tax specialist today could save you far more than it's going to cost you down the road. This question isn't, of course, whether tax authorities are getting better at tracking crypto. They are, of course, I would add. The real question here is whether you act before they knock on your door.